Retail real estate is dead. It's gone. That's what everybody said. Amazon is going to kill it. E-commerce is going to bury it. Shopping centers were going to be the next ghost towns. Well, here's what actually happened in 2026. Retail vacancy is near historic lows. Lease-up timelines are the fastest in years, and JP Morgan just said we're seeing the strongest shopping center valuations in a decade. Today, I'm going to break down why the retail is dead narrative was one of the most expensive lies investors believed, what's actually winning in the sector right now, and how to think about positioning yourself in this cycle if retail real estate is an asset class type you're interested in commercial. This is in my lane. I've got receipts for this. So let's go ahead and dive in. Hey, what's going on, guys? Welcome back to the Millionaire Mindcast. As always, your host, Matty A. And as many of you know, I've been building wealth through commercial real estate my entire career. And specifically, shopping centers have been one of the asset classes that I have done many value add projects in. So if you are thinking about your next move in commercial real estate, or maybe you're thinking about retail, then this episode specifically is for you. Now, for years, the mainstream real estate conversation went like this: retail is dying, and every bankruptcy, whether it was Bed Bath & Beyond, Party City, Pier 1, Sears, I mean, you name it, right? There was a lot of big box noise that supported this narrative. They kind of became another nail in the coffin. Well, every retail apocalypse headline got shared over and over and over again. And I'll be honest, there were certain times where I was like, oh shit, should I not be invested in retail real estate? Like, is this, the beginning of the end? But here's what the narrative got wrong. And again, I try and avoid a lot of the headlines and talking heads, and I try and just dive into what the data says. And what the data says is it's now making it impossible to ignore. So let's dive into that. Now, JP Morgan's 2026 commercial real estate outlook said it plainly. We're seeing the strongest valuations in a decade across active shopping centers, excluding regional malls. Now, that's a whole different kind of subcategory of retail, one that, pretty much only institutions play in. So that's really not affecting, let's call it the mom and pop, or applicable to the mom and pop investors like you and I. So not multifamily, not industrial, retail shopping centers, we're seeing the strongest valuations in a decade. Now, CBRE's 2026 outlook echoes it. Risk-adjusted returns in retail look especially attractive right now, specifically for well-located grocery anchor and open-air centers. CoStar, one of the most trusted data firms in the industry, reports national retail vacancy sitting at approximately 4%. So that is historically low. Now, meanwhile, the average time to lease retail space has dropped to 7 months, which is well below, again, the historical norm of 10 months. So what does this mean for investors? Well, it just means that there's more demand than supply. Landlords have the leverage. And good space, if you're in a good location, you got a nice property, good space is moving much faster than it ever has before. So that's not the signs of a dying asset class. That is the signs of somewhat, I don't want to say a protected asset class, but it's a tight market. It's a demanding market. Now, and this is the critical part. Not all retail is winning. So let me put that asterisk next to it, right? You're not just going to buy a retail, commercial asset and win. The bifurcation is massive, and understanding it is the difference between a great investment and a bad one is really important. So let me break down exactly what's working and why. Now, let's start with the winners. The winners are necessity-based, value-oriented, and they're open air. So if you've got a grocery, anchor in your center, neighborhood strip centers are doing well, that kind of, service neighborhoods and areas. We've got open air shopping centers anchored by national credit tenants, discount retailers, home improvement, healthcare, fitness, food, right? That's what one of my shopping centers is going to be, is Harbor Freight and TJ Maxx will be, discount retailer, home improvement. So those are doing obviously very well. So the common thread here is these are all tenants people visit out of necessity and habit, not impulse, not a want, but a need. You cannot get a haircut from Amazon. You can't get an oil change. You can't go to urgent care. You can't take fitness class through an app. You can't go sit down in a coffee shop. These are experience and service-based businesses that truly require physical, tangible space, and they are the most active expanders in retail right now. Aldi, for example, grocery store, is adding over 180 stores across 31 states in 2026 alone. TJ Maxx, one of my tenants. They have, TJ Maxx companies has TJ Maxx, Home Goods, Marshalls. I mean, they've got multiple underneath the parent company. They continue aggressive growth. Five Below, Harbor Freight Tools, Dave's Hot Chicken. These brands are not contracting. They're all hunting for well-located space. Now, the losers are, of course, what you've read in the headlines, the big box legacy retail, aging enclosed malls, discretionary category killers. The bankruptcies of, say, the Big Lots, the Party Cities, the Macy's, they left large swaths of big box space sitting vacant. And that's what a lot of people relate to retail. Particularly those were spaces, 10,000 square feet and above. And that's where the softness in the market is concentrated. But here's the insight most people miss is that vacancy isn't a graveyard. It's an opportunity because the national tenants who are expanding aggressively want exactly those same footprints. I think Harbor Freight's taken over 15,000 square feet. TJ Maxx has taken over 20,000 square feet. They want them in centers that already have proven co-tenants drawing that kind of traffic. And the national tenant rep specialist that I connected with, they put it this way, to kind of paraphrase what they said. If you have quality real estate in the junior box range of 20 to 30,000 square feet, there is still a shortage of opportunities for those big tenants. And that's not a distressed market. That's not a distressed asset type. That is actually scarcity. And scarcity creates pricing power for landlords who own the right product in the right spaces. Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Amogus Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. So I'm not just, reading research reports here that are, helping me come to these assumptions. I'm playing in this space. I'm experiencing it firsthand on the front lines right now. I'm operating in this sector right now. The biggest one that I'm working on right now is a value-add shopping center anchored by TJ Maxx and Harbor Freight Tools, which are two of the most traffic-consistent, recession-resilient tenants that you can have in a center. Both are textbook examples of the value-oriented, necessity-adjacent retail that's leading the sector. And what we've seen operationally aligns with the data that is showing, which is tenant demand is real. And the right operators have leverage, and the gap between quality assets and mediocre ones is, I don't want to say widening expansively fast, but it's widening. And that bifurcation is a great signal that there's opportunity here still. The operators who understand it and act on it are the ones who will capture the upside of this cycle. There's a guy that I've been following on X for some time. What is it? Real Estate Trent, the strip mall guy. I mean, his fund is continuing to expand, and he's buying shopping center after shopping center like they're going out of style, and he's crushing it. I know many others that are doing really well in this asset class as well. So let me zoom out and give you the framework. CBRE projects total commercial real estate investment activity will increase 16% in 2026 to $562 billion. That's nearly matching pre-pandemic levels. So that's a positive thing that there's still, capital demand coming into the commercial real estate space. And the institutional capital coming back into the market is doing so with a risk on posture, specifically targeting sectors with strong fundamentals and limited new supply. Retail is one of those, specifically open air, grocery anchored, and the value oriented centers. Those check both those boxes. And really, there's been limited new construction for years. The cost of building these things it doesn't pencil as much. So you're not seeing as much supply come online. So there's tight vacancy, growing tenant demand for the right names. But here's the window. We are early in the institutional repricing of this sector. And when the big money fully re-enters an asset class that has been underpriced for years, cap rates are going to compress because they've expanded a little bit. They're going to compress back down, and we're going to see some pretty good appreciation in these values rise. The opportunity for smaller operators to get in then is much harder. Now, there's a window. So think of it like a train leaving the station, right? Institutional capital boards first, then the sophisticated private operators who saw it early, right? Then the crowd. You don't want to be reading about this trend in 2 years, wondering why you didn't move when the data was clear. You want to get on board, before one institutional capital or right at the same time or right, shortly thereafter, before the train leaves the station. So if you're a passive investor, this is the moment to find good operators who are already in this space, people with track records, national tenant relationships, and the operational expertise to execute value add retail. Again, if you are interested in passive income opportunities that aren't equity and pro forma based and are just debt based and want to clip a monthly coupon, you can text the word income to 844-447-1555 to learn about the Amogus Income Fund. If you do want to get involved in syndications and invest and share in the upside in deals like this, text the word deals to 844-447-1555 because those are the investment opportunities to partner with us as an LP. So connect with people like me, other people in your network. There are many, good operators out there. There's also more bad operators out there, so be very careful of that. But evaluate their thesis, right? Understand their tenant mix and get positioned alongside the cycle, not behind it. So the narrative that retail was dead was one of the most expensive stories. Well, it could be, right? I mean, there is some people that already missed this boat, but I still believe there's plenty of opportunity ahead. Um, but this was something that many people in the investing crowd believed in the last decade. And I think that there's going to be some great opportunity because the truth is retail didn't die. It just evolved, like many asset classes do. The weak got weaker, the strong got stronger, necessity-driven, value-oriented, the open-air retail, they got stronger. And right now, it sits at some of the most attractive risk-adjusted return profiles in all of commercial real estate. Like JP Morgan said it, like CBRE said it, like CoStar confirmed it with the data. The data and the deals on the ground are aligned. So the biggest risk is, of course, in my opinion, not taking any risk at all. In a world that is changing rapidly, the only strategy guaranteed to fail is just not taking risks and sitting on your hands. You got to evolve, and your risk has to evolve, and your appetite has to evolve alongside the world and meeting it where it's at and taking what it's giving you and figuring out which opportunities, which risk, which income and upside most align with your investment goals. So just don't be one of those people that lets the wrong narrative cost you the right opportunity. So if this episode opened your eyes to a sector that you'd written off, I'll ask, share it with somebody who needs to hear it. share your thoughts. Are we going to continue to see great upside in retail, or do you think I am smoking the good stuff? Links and resources in the show notes, as always. Keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys in next week's episode. Cheers. Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media, at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.